So, Steve, quick question. What do you remember about 1992?
1992, that would have been started my senior year of college, looking for a job, and all my friends trying to find jobs in a slow economy.
I can appreciate that. It's one of those things that, if we think about some of the pop culture events, right? We had movies coming out, Aladdin, Home Alone 2, those were two of the big movies. I was also right in the first run of Michael Jordan's 3 NBA championships. But there was something else that was interesting there, and it kind of goes back to what you're talking about in reference to, trying to focus on finding a job, fiscal health, all those sort of things. That was actually the last time the Federal Reserve was this divided on what to do next. It's something that so often they try to be unanimous. And yet during that era, they were not very unanimous. And now here we are in 2026, and we just saw that level of disagreement again. And there's two parts to this now, Steve, that I'd love to understand and get your input on. The first part is we have a transition occurring. We have someone new coming in. But then the second part, if the people running the economy don't agree, what is everyone else supposed to do? So, why don't you share your thoughts?
So yeah, just last week the Fed did meet and they voted not to increase or decrease interest rates, so nothing changed there. And then also the Senate voted to approve Kevin Warsh to be the new Federal Reserve chairman starting May 15th. So he'll take office then. And it's interesting because they're faced with a difficult decision. It's why they don't agree. Because it's very complicated because do you raise interest rates? Do you lower interest rates or do you just do nothing? And so it's important to understand the consequences of each one of those. So if you look at lowering interest rates, why would they want to lower interest rates? Well, that usually is a great way to spur economic growth. So if you think about it from this standpoint, let's say a business, they're thinking about borrowing money to go build a new plant, but interest rates are a little bit high. Well, if interest rates come down, well, now it makes sense to borrow that money and build a plant, hire new people, grow the business. And so the lower the interest rates are, the more business that can spur. Same thing with real estate. You think about buying a house, but you can't quite make that monthly payment on that house you're hoping to buy, but the interest rates come down just a little bit. Now you can buy that house. So what happens? Now there's realtors get paid, title companies get paid, contractors get paid, appraisals get paid, all these different things. And it really just spurs the economy. And that's just one house. And so when you have that, you have the contractors that make repairs, all those different things. When interest rates get lowered, it spurs real estate and the economy as a whole. So that's a great reason to lower the interest rates. But then, are there any negatives to lowering interest rates? Well, if you do that, sometimes it can spur so much growth that it actually causes inflation to take off. And so that's the dilemma is, do we lower interest rates, which spurs growth? It also helps with unemployment because as you're growing, more places are hiring, more jobs are being created. So it lowers unemployment. And so there's a good argument to lower the interest rates, but at the same time, it can also spur longer term inflation. And so how do you fight inflation? Well, actually, you raise interest rates. So right now, they're kind of stuck. Real estate has been slow. The economy has been slowing down a bit. So you'd want to lower the interest rates. Unemployment has been getting a little bit higher. So you'd want to lower the interest rates. But inflation has been picking up. Oil prices, because of things going on in the Middle East, have really picked up. And so there's a lot more fear of inflation. So if you're afraid of inflation, you would want to raise the interest rates. And that's where that conflict comes in you're talking about. You're trying to fight multiple battles, and one calls for you to lower interest rates, and the other calls for you to raise interest rates.
The thing that kind of strikes me there is, the rates didn't actually change. And so, why wouldn't the rates change with what we're at right now? Is it as simple people don't know where we're headed?
Yeah, and that's just it. Is, well, should we lower them or should we raise them? And they couldn't come to an agreement, so we'll just leave them as is. And so it's kind of we've been for a little bit.
Well, and especially when you look at a transition period where we have a new chair, what sort of impact from your experience does that chair do in terms of setting monetary policy going forward?
Yeah, great question. So, again, the decisions of the Federal Reserve are not made by one person. So if you change just one person, that's not an automatic guarantee, hey, it's going to take a whole new direction. It's a committee of, I believe, 12 different regional governors and the Federal Reserve that vote. And so having a different chair can lead that in a different direction. Maybe he can, if it's a 50-50 tie, maybe he can persuade people to do something here, do something there. So he can certainly have an influence on the direction that things take. I think when you have for lack of a better word, a split decision, that influence can change what people end up wanting to do. And I think that's what you're going to see. And I know that Trump has been saying for months, lower the interest rates because it's going to make them look better. If the economy takes off, there's more job creation, there's more business development, there's more real estate sales, things like that. That's going to look good for the economy. And so I can understand that. And I don't think Kevin is just going to lower interest rates because the president wants him to. He's a smart person who's been in the reserve for a while. He understands economics. But at the same time, I think that's what they're going to do. And the reason is, if you look at all the pros and cons, you've got multiple benefits to lowering the interest rates. And they get multiple advantages, one disadvantage. And I think they're going to hit a point where they're going to say, okay, for the economy, for real estate, for jobs, let's lower the interest rate and we'll fight the inflation later. That's my best guess as to what they might do. But I can see the logic in it. But that's not a prediction. It's just kind of a guess.
Certainly, it's always a dangerous game to try to forecast what's going to happen. And I think you have those three different paths, right? Raise rates, lower rates, hold steady. But there's something else that you mentioned that is unique about the Fed, which is the Fed is always had at least some amount of independence compared to the party that is in power. And why is that? Why do we want a Fed to operate that way?
Well, we'll take a quick step back. We'll talk about what the Federal Reserve Bank. What it is not federal. It's not part of the U.S. government. It's not a reserve. It does not hold money, and it's not a bank. You can't go put money into it. So, the Federal Reserve Bank is actually none of those three. It was created in 14-ish, somewhere in the teens, and it was created by the major banks to help kind of give some guidance to the U.S. economic system. And so it is independent of either party. And that's kind of the point, is it didn't want to be kind of beholden to this party wants me to do this or this party wants me to do that. And so when you look at the terms, I forget how long they are, but they're very lengthy terms that the reserve chair is for. For example, the one that's ending right now, he was appointed by Trump during Trump's first administration. So I don't remember the exact year, but again, they're designed to stay in office for a while and lead the Federal Reserve. And again, to do so, regardless of who's in power or which party or which president. And that independence is what we want, so that they're not just, again, working for the benefit of one of the two parties.
Which makes sense because you have those short-term goals to try to get elected. But at some point, you also have the long-term future. And if there's some sort of cyclical nature of things where eventually the other party is going to be back in power, you can run into the risk of kicking the can down the road to the point where it has dire consequences. And so what it sounds like here is that, we have three different potential paths that we're really talking about today: raise rates, lower rates, or hold them steady. And none of those are the perfect solution. From that perspective, then, if we think about like the concept of lowering rates, you talked about how you felt like that was the direction that they were going to do. Can you dive more into, really the negative things that can happen to the economy if we're lowering rates in the current environment?
Yeah, and it's interesting because the biggest negative by far is the fear of inflation. And so we'll kind of break that down to a short term, medium term, long term, because it's kind of interesting. So when you lower the interest rates, the immediate impact is there's more credit, there's more money available. People can borrow money to buy houses at lower rates. Businesses can borrow money to expand, to build plants or do whatever, to get equipment. And so there's a spur to the economy in the short term. But then as that picks up and takes off, then what will happen is it will spur inflation, which will then actually, usually it will increase the interest rates, which slows all those things down. And so the short term is a kind of a jolt to the economy. Midterm, you're going to have inflation you're going to have to deal with, and a downturn to the economy. And, to your point, long term versus short term consequences. But then here's the interesting part about inflation, because that's really the biggest fear. Inflation could actually have a long-term benefit. One of the strategies that people have been talking about for a while is, they're looking at the U.S. federal debt of $39 trillion as something that, how do we pay that down, get rid of that, whatever you want to call it. And if you look at the history, In the playbook, it's been done once before back in the 40s, right after World War II. And again, during World War II, we borrowed a lot of money and had what at that time was a record ratio of debt to GDP, is again how much the economy is producing. And our debt was a huge portion of the GDP. And so what they did is they intentionally, and I apologize, I forget the technical term for it, but they intentionally encouraged inflation. And then over a period of 10 to 15 years, even though they didn't technically pay down the debt, they rose the GDP by so much that the ratio of debt to GDP wasn't that much. And so from a long-term standpoint, it makes it, and another way of putting it is, paying off $39 trillion in today's market is very difficult. But maybe 10 years down the road, if your car costs $300,000 and your houses start at $2 million, the $39 trillion debt doesn't seem like as big of a number. You won't feel like as much if it's been adjusted for inflation after 10 years. And so that's actually just an argument for increasing inflation to minimize the impact that the national debt has on the overall U.S. economy.
Now we're getting into a really fascinating area because I can think of from that other perspective, consumer debt, someone with credit card debt or student loan debt, they love the idea of inflation from that perspective because it's not as much of a daunting figure if they have income or salaries to match.
Right.
The issue comes when you don't necessarily have those things. And so, is there a situation where that means that it ends up being good for government debt, but bad for the people that the government serves?
Possibly. I will point out one difference between where we are now and where we were in the 40s and 50s when we went through this once before, is during the 40s and 50s, most of the US government debt were 10-year treasuries or longer. So they were able to lock in low interest rates for 10 or 20 or 30 years and then force the inflation to increase. And so they were still paying low interest rates on all the debt as they experienced inflation. Right now, most of the US debt is actually in very short term, like 1 and 2 and 3 year treasuries that resets the interest rates on a regular basis. So if they caused high inflation, the interest payment on that debt would actually go up significantly as well. And so long term, there could still be that benefit of inflation making that 39 trillion not seem like as much, but it could also cause some complications with just essentially the interest payments on the debt. And that's the same type of thing that individuals might feel. Now, I will say from a credit card standpoint, is there much of a difference between 22 and 24% interest? I don't know. When you go to buy a house, again, think of where the interest rates were about 5 years ago. They were 3%. That was record low territory. It had never been that low to buy interest rates to buy a house. And then when it spiked up to 6%, which by the way has been about the 50 to 70 year average of 6%, but when it spiked from 3% to 6%, man, that made a big difference in house payments. And so when we talk about interest rates going up and impacting us individually, it kind of depends on which types of debt you're looking at. But to your question, it could impact the government less than it might impact individuals.
So effectively, this strategy, if it may, is not going to be as effective as it was in the 40s when we were in this situation previously.
Probably.
So then what does the government do to solve for that? Or is it just not a viable strategy, which is why we're resistant to inflation in the first place?
Well, and again, the way I was looking at it was that is not the sole goal here of just let's get rid of debt. But it's a consequence of if we lower interest rates, it could cause inflation. And is inflation a horrible thing? It's got some pros and cons. And that's kind of all I was saying is when you look at the worst case scenario of what would happen if they lowered interest rates, that worst case scenario of inflation going up a bit, they may not view that as that much of a negative.
Sometimes it feels like debt and the country's debt in particular is more of a political talking point than something that anyone has to solve. From an opportunity cost perspective, there are things that you have to do to actually make that happen. But I assume once again we're talking about trade-offs and trying to find the right balance of that. Greek went through a period of austerity policies back in the day that my understanding, were very painful for its citizens. And so I think that is certainly not something the politician is going to be able to sell very easily to most of their constituents, right? Putting that all together then, so inflation, has some benefits, but also has some real drawbacks. So, it sounds like we're trying to essentially thread the needle, find the perfect balance between these different things. And that's a very tough job to do. What happens if we just hold steady too long and don't change rates at all? What do we end up with there?
So what you're seeing right now is unemployment slowly ticking up month after month. Jobs aren't being created as fast. Part of that's the economy. Part of that could be AI and people thinking, oh gosh, let's see what happens. We may not need to create as many new jobs. And so unemployment has been ticking up. And if we do nothing, that probably would just continue to tick up. But also foreclosures and bankruptcies have been accelerating the last few years. It's nowhere near the volume that it was back in 2008, 2009, but it has been ticking up. And if nothing is done to spur the economy, to spur things like that, then those things will probably just continue to tick up a little bit higher and higher. And so, again, real estate has been slow. It would just continue to be stagnant. The problem with real estate is we don't have enough houses for the people who want houses. And when interest rates are higher, the builders don't have any incentive to go build houses because they're having a hard time selling them because people can't afford them. People want houses, they just can't afford them. And so if we do nothing, it just keeps the housing market stagnant from a construction standpoint. Now, one of the thoughts I just had as you were speaking is, how does this all play into us from an investing standpoint? Well, own assets. What happens when we have inflation? Property values go up. Gold often goes up with it. A lot, during the last time we had something like this, oil prices went up with it. Unfortunately, we really saw that last week. Oil prices already going up. And so it's those physical assets, real estate, gold, things like that benefit during high inflation. And so it looks like inflation is coming. Therefore, then protect yourself by having those. And that's how you can actually benefit from high inflation.
So you would say that with the real estate boom that we experienced during the COVID era, that was partially a consequence of inflation?
And not really. Well, you get two different things. So you have the interest rates, because again, remember, we had record low interest rates right before COVID. And so the real estate was really humming along at that time. But then what we had is during COVID, there was an infusion of trillions of dollars into the US economy by stimulus and other things, and people had extra money. And so then once they had that money, they started buying things, whether it was houses or cars or whatever else. And that spending, that's what spurred the inflation. And so the housing prices were already going up regardless because the real estate had been doing well for a while, but that cash infusion caused the inflation, which just kept the real estate continuing to appreciate year after year.
So you basically had the stimulus on steroids, and the result of that was that people were more than willing to continually to jump up, because part of, if you think about housing, that's the American dream. The one other perspective from an investing scenario, I was just thinking about this. You had just told me, last week, a refinancing story where your rate changed after you had already started the process to finance or refinance a property. And so that kind of, the takeaway there, if you wouldn't mind, sharing a little bit more about that, is you can try to do everything right and you can still get impacted, with your plans getting disrupted. Do you want to talk about that a little bit more?
Yeah, basically, I just was refinancing one of the properties that I had, and I'd actually acquired it with private money, private lender a little while ago. Needed to refinance it, pay that off. Not a big deal. Rates were reasonable when I started, and takes the mortgage companies. They said they could close within 3 to 4 weeks. I've yet to ever find one who could close in a time period they said they could. But what they didn't say is, yeah, after 30 days, we're going to adjust your rate to the highest we possibly can. And so it took them about 35 days by the time they got all their paperwork and underwriting and all that stuff put together. And then 3 days before closing, they're like, okay, now that we're ready to close, it looks like interest rates really spiked up yesterday. Sorry about your bad luck, but your rate is now going to be this instead of what we'd originally told you. And again, it's one of those, we're far enough along, it still makes sense to refinance, but it's unfortunate, but just change the payment a little bit, change the structure of it. But I'm still closing, but yeah, you're kind of subject to the volatility of interest rates from time to time.
Well, it kind of makes me think, right? That this, part of the conversation today, it isn't really about whether rates go up or down. It's about how exposed someone is to the changes that are occurring.
That's true.
And so, from that perspective, for the average listener today, or the investor or the consumer, you know, what should be our principal takeaway about the current standing with the Fed
Well,
and
and
where
that's kind
things are
of,
going?
yeah, it's kind of what I was pointing out is, making sure that you have assets that will benefit you during inflation. And that's where those physical assets, again, the real estate, the gold, that sort of stuff is advantageous to have that in your portfolio because that's what's going to give you more protection. If you keep most of your money in the bank or a CD or something like that, then the inflation will eat away at the value of your money faster than it grows. And so that's really the key takeaway isn't to go panic and throw your hands up in the air that all hope is lost, or to panic that the U.S. has a huge debt, which it does, but it's to say, okay, if this is the direction things are going, how can I protect myself the most? And the answer is by owning assets that benefit from inflation.
Right. So, by being an informed investor and understanding the trade offs, that at different times, any of these three strategies is arguably the appropriate strategy, you're able to reduce your dependence on one outcome and, build flexibility. And so, if we think about the rest of 2026, being uncertain, you talk about jumping into assets that are less dependent on what's happening over here. Is there anything else that people should do to prepare for the future if the economy is going to remain uncertain?
Yeah. So going back to the analogy of what the government learned from what it did in the 40s and 50s versus now, I pointed out that the benefit that it had at that time was it had so many things in longer term debt where the interest rates weren't changing from year to year. And you would want to do the same. So if you've got any debt that you can refinance when the rates are either current rates or lower. So in other words, if they lower the rates and there's a period of 3, 6, 10 months, whatever it is, where rates dip even lower, refinance or buy assets. Take advantage of that because what's going to happen is when rates go back up or inflation kicks in, you've locked in really good interest rates for a long period of time. And that's really how you benefit from it the most. You go out and buy a house today, let's say it's 200,000 and you buy it at a 6% interest rate. And then 3 years from now, inflation and interest rates are 8, 9%. That house is appreciating a lot. I mean, think about a $200,000 house appreciating at 8%. That's a $16,000 just in appreciation. And so you're acquiring an asset that goes up in value, but you've locked in your obligation, your debt payment at a low interest rate. So that's what I encourage you to do if you can and if you look at other gurus in the investing world, that's one of the things they'll tell you is you actually benefit from debt during inflation. And so go get debt, lock in low rates, and then as the assets appreciate, you're benefiting.
Makes a lot of sense. Ultimately, what I'm left with is we don't control the economy, but we can control how it affects us and what we do about it. And really, that's the thing to think about from here. Any final words that you'd say today, Steve?
I'm going to give you one prediction, and I have a 100% success rate with my predictions. When it comes to the stock market and the economy, it will be volatile. It will go up and down, and there will be surprises we didn't expect. That's my prediction. It's a pretty safe prediction. And so if that's what you know is going to happen, then how do you protect yourself?
Right. And the one other joke that someone might say, from that perspective, is we know that the chart for the stock market is going to continue to go to the right. That is what we can say with absolute certainty.
I like that. Yeah.
But all right. Thanks, Steve.
All right. Thanks so much.
We'll
Good day.
we'll catch you next week.
All
Okay.
right.
Bye bye.